Hey everybody, Real Estate Ninja here. You know, the Economic Ninja doesn't own that whole snappy thing. I'm gonna take it over. All right, Real Estate Ninja here. We're gonna be talking about US mortgage lenders are starting to go broke. And I believe that you're gonna see this trend as long as interest rates go higher and people stop buying real estate and people start selling real estate, get bigger and bigger. But then it's going to reverse. We'll talk about that in a second. Okay, the U.S. mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates, and a wave of failures that's coming could be worse since the housing bubble burst about 15 years ago. It said there's no systemic meltdown coming this time around because there hasn't been the same level of lending excesses, and because many of the biggest banks pulled back from mortgages after the financial crisis. Let me stop there, just so you know, there were a wave of loans that were made, and you're going to start finding out, and I'll start doing some more stories about it, that were 100% loan to value, LTV. And many people don't understand that. They think that it was all cash buyers, but actually you can go to better.com and go find yourself one yourself. And it is something that the industry has been keeping quiet for some time. And you'll find out that the loan to value ratios were all out of whack. And well, we'll start seeing that uncovered pretty soon here. So yes, I do believe that we are going to see a meltdown. And if you think about it, you know, they talk about there's no meltdown, but yet there's businesses starting to go out of business at a rapid rate when it comes to the mortgage industry. So that actually is called a meltdown. But, you know, hey, we're just in the beginning, the first throes of this bad boy right here. It says, but market watchers nonetheless expect a string of bankruptcies broad enough to trigger a spike in layoffs in an industry that employs hundreds of thousands of workers and potentially an increase in some lending rates. More of the business is now controlled by independent lenders, and with mortgage volumes plunging this year, many are struggling to stay afloat. Now, I saw the Economic Ninja do a story a while back, oh, it was about, let's say 4 months ago, on one of the biggest first American title company branches closing their doors in Ventura, California. And that was a big deal. And he got a lot of hate for it. And the reason why is people are like, it's just one business. It's not a big deal. Well, it actually is, because First American Title is one of the big four. The big four mortgage title, or sorry, real estate title companies in the country. They are massive. And to sit there and for them to go, we're shutting our doors on one of our busiest offices in California. And I mean, we're talking the nearest ones in either direction were an hour away. It's a big deal. And they closed their doors very abruptly, took it off the website, scrubbed the entire thing. Their employees didn't even know they were closing until literally they got back from lunch that they were all been laid off. And it is a big deal. And why did they close? Is because they literally saw an instant drop in business. Well, you're not going to see that as the only example. There will be more. Why? Because a lot of businesses are leveraged. Just because you're the biggest out there doesn't mean you're not leveraged. And you're going to start seeing that as refinances crater. They have been absolutely cratering, and more companies lay off their employees because the mortgage industry is a very expandable and retractable kind of business, right? It's very fungible, if that's the right term. They can expand and contract very rapidly with changing mortgage environments. Now, in 2004, it says here, only about a third of the top 20 lenders or refinancings were independent firms. Last year, 2/3 of the top 20 were non-bank lenders, according to lendingpatterns.com, which analyzes the industry for mortgage lenders. Since 2016, banks have seen their share of the market shrink to about a third from about a half. Oh my gosh, it's so confusing. According to news and data provider Inside Mortgage Finance, many of the so-called shadow lenders will emerge from this slowdown relatively unscathed. Now think about this. Let me read this again. Many of the so-called shadow lenders will emerge from this slowdown relatively unscathed. I do not think that is true, actually. See, the thing is everyone keeps saying this time is different, this time is different. Heck yeah, it is. It's way worse. Why? Because this massive balloon in the price of real estate was predicated on two things. Stimulus that was injected into the economy. So a lot of people had a handful of thousands of dollars extra in their pockets so they can go out and buy real estate or buy items. And literally historic lows in the mortgage industry. Never, ever, ever, ever seen before. Then you tap on inflation that is right now at 40-year highs, but it's going to get worse. People don't understand it. It's going to get worse because the Fed's not doing anything fast enough to jump on top of it. and you have the global currency regime being split right now. To say this is worse is the understatement of the year. But hey, guess what? There are a lot of people that are reading these stories, writing these stories, or real estate agents that are trying to sell you houses that were not only even buyers in the last boom in the early 2000s, but they weren't investors. As a matter of fact, you go on YouTube right now and all you see is people pumping this stuff up, and this time is different, this time is different. They didn't even own their own home back then, let alone invest in many properties, right? So who are you taking your advice from? A guy that just read a couple books and didn't sense the change in the air when people went from net buyers of real estate to net sellers? Nah, that's what's crazy. That is why that economic ninja guy, the real estate ninja, got to get this straight, is telling you, yes, this time is worse. Because I did do that. I was an investor back then. So, and in one example I'm going to close with, it says First Guaranteed employed 600 people before it filed bankruptcy in June and made $10.6 billion in loans last year. According to the court records, days before seeking court protection, the company fired 471 workers because it couldn't get enough financing to overcome a cash crunch. And we're going to see that over and over. So the more people that get laid off in this industry, it is going to flow out to the real economy. That is less people that are buying, going out to eat, going on vacations, and so on. So you know that it's going to get worse. All right, guys, I'm going to link this story below. I hope you got something out of it. There's going to be a ton of doom and gloom on this channel, right? Because it's the facts. As a matter of fact, I had some really interesting comments the other day, like, hey, can't you come up with something positive? You know, this stuff is bumming me out. And I said, well, you shouldn't watch the channel because all I'm doing is providing the real news. This is actually what's really happening. If you can't handle it, there are videos of cats out there. I don't know where I've heard that before, but they're amazing. And you could just feel good all day long. Me, I want to take advantage of this and I'm going to go out and crush it. So I'm saving up, getting out of debt, getting ready to absolutely crush it in this next real estate crash. All right, guys, that being said, the Real Estate Ninja is out.